Good morning. We are going to discuss about the tax. It's an important role in our government also. A tax is a mandatory fee or financial charge levied by any government or an individual or an organization to collect the revenue for public works providing the best facilities and infrastructure. The collected fund is used for different sectors in the public expenditure program. If one fails to pay the tax or refuses to contribute towards it, will be invites a serious implication under the predefined law. So it is a very important under the tax. Next we see it is a financial charge levied by the government or individual or an organization to collect the revenue from the public, providing the best to give the public. Under this tax, you have the direct and indirect tax. So divided into two tax, direct and indirect tax. Under the direct tax, it is tied to the tax levied by individuals or entities or organization directly by the government. These taxes are imposed on the basis of taxpayer ability to pay, meaning that to the higher incomes or more valuable asset. It cannot be transferred to any other person or entity. This is only one such federation that winks at the direct tax. That's the Central Board of Direct Tax covered by the Department of Revenue. So Income Tax Act, it was passed in the year 1961. The income tax by this act can be generated from any sources such as profit, received from salaries and investment, owning property or use of business, etc. The IT Act also defined the tax benefit you can avail of life insurance or a fixed deposit. It also designed to save from your income, that is, the investment on the tax slab for your income tax. So, under the tax, you have the Wealth Tax Act, Gift Tax Act, Corporate Tax. Wealth tax, it is a minimum. The individual exceed 30 lakhs at 1% of the exit amount is payable on the tax. So it was announced in the year 2015. So it is a charge only 12% to generate the income for more than 1 crore. It is also capable for the companies those are generating the about 10 crores. Then gift tax, it was established in the year 1958. So 30% of tax on gift like shares, jewelry, property, etc. This tax was discontinued in 1998. So current rules, a gift from family members and local authorities are tax exempted. Gift from other exceeding 50 lakhs or taxable is payable free. Corporate tax is a direct tax levied on the profit of company registration in India. The current corporate tax in India 30% of positive domestic companies, 40% in the foreign countries. So these various deductions and exemptions available in the companies and can reduce their effective tax rate. So Security Transaction Act, it was levied by the sale of securities, stock, mutual funds, and it is requested by the stock exchange in India. And the rate is 0.1 and it was the further contract is 0.05. Capital gain tax, it is levied by the sale of asset, bonds, real estate and other investment. So it is a period of asset only when it was sold. For example, short-term capital gains or equity shares, 15% is a long-term and equity shares exempted from tax. So this indirect tax is preferred for the indirectly levied by the government or individual person or these are different direct taxes as they not imposed on the individual who sell out them directly in Indian government. The most common example is given sales tax, levied on the important goods value added tax that is imposed on the estimating with the price of the product or service like to push them for the product up. So under this you have the sales service tax. Sales tax is levied on the sale of goods and services and it is being retail price of a percentage made. This tax is collected by the seller and remitted to the government. Service tax is the rate of 15% applicable by the provided by the companies. The tax providers will pay by the individuals, it will maybe for the 40%. So under this you have the GST, that's the goods and service tax, value added tax, custom duty, and excise duty. So we have the advantages with direct and indirect. Under this, based on the ability to pay higher income contribute is collected the point of sale, direct payment, this indirect payment, less influenced, easily adjusted with the consumers. So disadvantage, complex calculations, is a higher burden, high rates of discouraged investment, and it's difficult to understand the tax amount. Thank you.